we knew that Wachovia was in trouble. I really didn't think. I thought that Wachovia would find a way to come through the crisis. But in early August, somebody had handed me a piece of paper, and I couldn't tell whether it was true or not, and talked about how the FDIC was going to try to sell off Washington Mutual and Wells Fargo, mainly because they were so deposit rich that if they were to have a run on those institutions, it would threaten the integrity of the FDIC.
Mark Vitner, the Deal Ranch podcast. Mark, thanks for having me in your home where we're recording this, but excited to speak with you.
Great to have you up in Charlotte.
So you're the chief economist at Piedmont Crescent Capital, but also formerly senior managing director and senior economist at Wells Fargo, and that evolved a couple times too, so we'll get to talk about both of those. Do you want to give an overview of Piedmont, your role at Piedmont as the owner of the company, kind of what you do now, and then we can go back in time to kind of go through the years?
Sure. Piedmont was an idea that I had for a long time, and I wanted to do it when I still had plenty of years to go out and work. And the initial idea was just to have a small economic consulting firm that worked for a handful of companies that were not large enough to have a full-time economist, but could benefit from having a part-time economist. And hopefully across a broad assortment of industries and with companies that I know, and it's turned out to be exactly that. That's what it is. And I've been fortunate in that I really haven't had to go out and sell the company. People have called me up and asked me if I would be willing to take them on as a client. And so I've been very fortunate in that aspect. And from there, I'm not quite sure where I want to go. I mean, with the name Piedmont Crescent Capital, I chose that specifically because geographically, the Piedmont is kind of the sweet spot of my regional economic knowledge, and the Piedmont, in my view, stretches from northern Alabama up to Washington D.C. Technically, it goes all the way to New York, but it's but the center of the Piedmont is really the crescent that goes from the northern part of Alabama up to Washington D.C. And so I do focus a little bit on that region, and by including capital, at some point I would like to start a fund that would focus on startups in that region. I mean, that's my ultimate objective, but I'm not there yet. I've got too many other things that I'm doing right now.
Right. How many companies are you working with right now? And then also, what's the basis of each company? Are they all real estate related?
Well, I'm working with 7 different companies and trade associations right now that I would say that, and they range. A lot of them are either real estate related or construction related. So there's a number of building products companies. Also, there's a lot of there's a accounting firm and a law firm that are focused on real estate.
Okay.
Well, I'm working on the focus on real estate, and then the American Home Furnishings Association, furniture, which is closely tied to the housing market. So there's quite a bit. I do one-off presentations for a number of groups that I've been doing them for years and continue to do that, and I don't include that in my core client base, but it's certainly enough that keeps me busy.
It seems like a lot that keeps you busy. So I appreciate you taking the time to do this. You're a nationally renowned, if not world-renowned economist. You've been on CNBC countless times. You worked at Wells Fargo and Wachovia during an interesting time in 2008. So if we go back to maybe just post-college to talk about your interest in economics and then your career journey, I think we can spend some time on, or a bunch of time at Piedmont at the end, but I think that would be a good way to tell your story.
Oh, absolutely.
So what was your interest in economics through school, and then what made you want to stay in it after?
Well, when I first went to college, I was a mediocre soccer player, and I began college at Winthrop in Rock Hill, and It was a place where I could be on the soccer team, maybe get into an exhibition game or two, and that's one of the reasons that I went there. The other is that their program matched up well. Their academic program matched up well with the University of Georgia, where I ultimately knew I was going to transfer at some point. And I remember from day one, when I went there and meeting with the counselor and saying, "Gosh, I've never met somebody who was focused on their transfer before they even went to class." But I brought up Winthrop because that's where I kind of made the switch from focusing on international business to focusing on economics, and I was very fortunate because when you take economics at a big university, you're usually in a class of a couple hundred people. And you might even be watching it on TV. I mean, that's the way a lot of schools are. I don't know that I would have had the interest in economics if I didn't have it up close and personal like I did at Winthrop. And I tell people that I learned a lot about economics even in outside the classroom, because there was a bar called The Money, of all things, right across the street from our dorm. And I think it was on Friday nights, they had a beer special between 6 and 7 o'clock where you could get a small cup of beer for 10 cents. And so we would load up an entire table with beer, and it'd be a little warm. It wouldn't be so good at 10 o'clock, but we made sure we had plenty of liquidity to make it through the night. And I tell people that the one thing about having too much liquidity is that it causes you to do some very stupid things.
Of course, that's
so
brilliant.
It's a lesson that I've carried through me throughout my whole life. But so I kind of switched from focusing on international trade and international business to economics, almost right off the bat at Winthrop, and transferred to the University of Georgia. And at the time, I didn't know how strong the economics program was at the University of Georgia. And the University of Georgia is very much a Chicago-styled school. Doesn't mean they don't teach you the Keynesian school of thought, but there are a number of professors there that were at that time that were monetarists, including a professor named Richard Timberlake, who Milton Friedman in his memoirs said was one of his top 3 students. And I didn't get to take his class until the last quarter. We were on quarters back then. And when I remember when I took his class, he'd ask everybody in the class if anybody had taken macroeconomics already. And I raised my hand. He goes, "Well, you won't get credit for this class." So I was like, "Well, I'm taking this class so I can take it under you." And he was like, I don't think anybody in the class realized that we were taking, that we had a world-renowned professor that was teaching us, and it was just an excellent experience. But from the University of Georgia, I went right to work at Barnett Bank. I had thought I was getting to graduate school, and I was planning on going to Duke, but I got accepted to Duke late. I'd been accepted at a couple other schools, but I really wanted to go to a top school. I got accepted there late, and I had already looked at some other jobs, and I wasn't really crazy about it. And I was like, well, maybe I'll go to another program, transfer to Duke. And the guidance counselor said, by chance, there's a fellow, an alumni down at Barnett Bank down in Jacksonville that's looking for somebody. And that's how I wound up going down to Barnett. I called him, went down there for an interview, and started working there about 4 weeks later. So right after, when we were on the quarter system, graduation was late. So we finished the year like in mid-June, and I started working there on June 30th. And so I didn't have much of a summer break, but that's okay because you're ready to get on with things after college, and wound up moving down to Jacksonville. And the very first week I'm there, I started writing a weekly economic newsletter called the Barnett Economic Week. And one of the things that I noticed, and I never really knew how the economics world worked, but it seemed like we're all covering the same thing, we're all saying the same thing. And I said, gosh, but it just seems that everybody that gets quoted in the papers, because I don't even think we had CNN. I don't think we had CNN, but we didn't have. We may have had CNN, FN, or Financial News Network back then, but I'm not quite sure. But that was in '84. And so I had this idea because we sent everything out by the mail, and I said, "How about if I go to the library, research all these economics reporters, and sent him a complimentary copy of her newsletter.
Wow.
And so I did that, and I think my boss was very skeptical at the time that I'd get any response, but just shortly thereafter, I was reading a piece in the Wall Street Journal, and I said, "Gosh, that's exactly what I wrote." And then, bam, there was my name after it. And I was less than a year out of college. I said, "Well, that's the coolest thing in the world." And so it was a great experience trying to write that newsletter and bring it up to a different level. But Barnett Bank was a relatively large bank when I joined there. It was the 25th largest bank in the country with $11 billion in assets.
It's like Florida's largest commercial lender at the time.
Well,
right?
they were the largest bank in Florida, and they were the largest retail bank. I believe Southeast Bank may have been a larger commercial lender, even though they weren't larger. And then Barnett eventually surpassed them. Mainly because they kept getting larger. But Barnett really was not a big commercial bank. And in fact, they hired the head of commercial lending from Wachovia, the old legacy Wachovia, to come in there, a guy named Sam Northrup, to come in and run the commercial bank because they really just didn't have enough juice. They weren't getting enough business for a bank the size that they were. And Florida's a little challenging market for a commercial bank. You had a lot of small businesses, but you didn't have a lot of large companies. You really didn't have a lot of what we'd call middle market companies at the time. And Florida was a smaller state than people think of it as today.
Right.
It was a very rapidly growing state. We were adding 1,000. The population was adding 1,000 people a day, but it was probably around half the size that it is today in terms of population.
Wow.
So it's really amazing. I remember we passed several states during the 1980s moving up the ladder. We were nowhere near the third largest state in the country. We were probably seventh or eighth. Wow. And so we moved past. I remember moving past Pennsylvania. But it was an interesting time. It was also right at the dawn of interstate banking. And so NC&B had a leg up on everybody because they found a loophole to get into Florida before anybody else, but they really hadn't exploited it that much at that time. And ironically, NC&B and Barnett Bank were the two companies that were really pushing for interstate banking. But on my very first day at work, Trust Company Bank bought Sun Bank, and that was 1 year before, because July 1st. 1985 was when interstate banking actually was legal, but you could make a deal because it takes about a year to close it anyway. Wow. So they announced that deal, and I think it caught everybody by surprise. And then there was a flurry of deals after that. And First Union was one of the companies that was most aggressive, and they bought one of the major banks. That was headquartered just down the street from us in Jacksonville, Atlantic Bank, which was just a bank with an incredible legacy, and also was a really good commercial bank. And when I made the switch years later to First Union, I came to a commercial banking lunch. And I would have thought that all of those companies would have been Barnett customers, but right. Every one of them was a First Union customer, and it just kind of blew my mind that they had every major commercial banking relationship in Jacksonville and really throughout much of Florida.
Wow. So what transpired? What evolved for you to go get the MBA, and then we can get to First Union here in a little bit too.
Sure. I had long planned on going to Duke, and when I talked with my manager at Barnett, they were like, well, why don't you think about doing something down at the University of Florida? And University of Florida was less than 100 miles from Jacksonville, so I could theoretically drive down there, take classes, come back, and so I said, okay, I'll look into that, and put off Duke. And they said, why don't you can get a master's at Florida, and then you can then get a PhD at Duke at some other time. So I kind of had that crazy idea in there, and so I said, okay, well, And then I thought, well, instead of driving 100 miles, I could actually take 2 classes at the University of North Florida, transfer those down to Florida. And as it is, I was very frustrated with the program at the University of Florida. I love some of the professors there, and I've got a good relationship with the University of Florida, but I never finished the program because, for one, they were going through some issues at the time and in the economics area, and we had, and there were times where I would drive 100 miles to come go to class, and there'd be no class. There'd be no class,
Oh, wow.
and I learned something in the program. But I opted instead to just transfer 2 classes back from that program, and then I was a quarter of the way through the MBA at UNF.
Oh, wow.
And so I just went ahead and finished that. And Barnett also sent me through a program that was a professional economics program at Carnegie Mellon, which was a lot of that was you studied for about a year and then you went up there for class and then
Right.
and I thought that was more relatable to what I did. I think one of my frustrations at the University of Florida was just how out of date what we were learning was. I mean, and it was so.
In what way do you think?
Well, we were learning about. There was a class on international trade theory, and I mean, I understand that you have to learn the basics, but we were just way behind what you could read, what you could learn from reading the Federal Reserve economic bulletins from the Federal Reserve Bank of St. Louis, for example. And I remember bringing him into to show the professor one time. I just said, this is frustrating to me because I feel like we're going back in time here. And he was just like, where did you get these? These are excellent. I'm like, well, you can get them at any public library. I mean, it's like, this is not, and he was a visiting professor and he was great. And I learned a lot from him, but it wasn't a lot that I could apply into the financial world. And I realized from almost day one when I went there, when every person in the program except me was striving to get a PhD and be a professor. And nobody was in that program to work in the private sector. And it just didn't seem to be a very good fit. And the PhD program itself, it was so analytical. And I remember we took in the microeconomics class, so I had class from 8 a.m. till 6 p.m. But the micro professor was the last class of the day. And he was like, there's not enough time for us to get through all this material, so we're just going to go to 7. And I thought, well, that was really great, except for I was going to drive 100 miles back home.
Right.
But it was too much to try to squeeze that in. And I had thought, for years I looked into to finishing the program because all I have to do is write a thesis and I've published many papers, so it wouldn't be that hard to write a thesis. But the last time I looked at finishing the program, and after being out for a number of years, the biggest holdup was that I needed to prove that I had all of these vaccinations in order to be enrolled in school.
Oh, wow.
And I couldn't do that. And the time that it would take me to get all those vaccinations, because you can't just go get shots. There's like a series. It would take over a year. And I was like, it's just not worth it. I mean, it's not, I've been working for 20, 30 years. I'm not going to go get all these shots. And I said, isn't there somebody I can talk to? Because I said, you invite me down to the university every year to speak to the real estate school. It seemed like if I'm safe enough to speak to all those students and faculty, that I'd be safe enough to speak before 5 faculty members.
Wow.
And there was, there's no, as there is in government, you can't get an exception for something like that. So I never finished the program, but I did learn some. I did, it's not like it was time that was wasted, but that's so. I tell people that I got an MBA. I say it's an accidental MBA, but and the MBA was actually more useful in terms of what I did. At Barnett, we had a big focus on small business, and I worked at the Small Business Development Lab in my off time and worked with small businesses to understand how the economy impacts their business.
Right.
And so I spent a lot of time on my career working with small business. And I think that getting away from just the economics classes and focusing on things like cost accounting. And, accounting to me always seemed very boring, and because it seemed very simple. I took it in high school, and then when I took it in college, it's the same thing. And I used to always explain to people, if you do something with your left hand, you got to do the same thing with your right hand. It just, it doesn't have to be the exact same thing, but it has to add up the same way. It's like, it's really that basic. And but cost accounting was very interesting to me, and then the business policy class. And so I enjoyed the MBA program. It wasn't the most challenging MBA program in the country, but I remember one of the professors is Dr. Shamley, who was a marketing professor. He said that this degree is like a growth stock. He said, 20 years from now, it's going to look a lot better than it looks today. And sure enough, that university has just grown tremendously, and not just in terms of absolute size, but in stature as well.
Wow. What was the transition to First Union? And what were you working on at First Union initially? How did that evolve over time? And how big, at a larger institution, how big is the economist pool? How many other folks are in that department? Do you work with a smaller group? What does that look like?
Well, the economics profession shrank tremendously. When we had the bank consolidation, a lot of people would get rid of their economist, because they would say, well, we've got one already, so one's enough. And so economics departments tended to be relatively small.
Okay.
For most banks, they tended to be 2 or 3 people. And the large investment banks in New York they would have larger staffs. I mean, they have much larger staffs. Back then, they probably had 20 to 30. Today, some of them have hundreds, but they are much more complex organizations and global instead of just being national. But not every bank had an economist, and so I felt fortunate to be at Barnett. I worked, in addition to economics, I worked in strategic planning, and one of the things that I did in the latter years that I was at Barnett is that I came up with a strategic plan. There was a group of banks that was up for sale, and they had been caught up in a scandal, and so the federal government was having to auction them off. And we wanted to buy just the Atlanta portion of that, because we had a bank in Atlanta. We were having a hard time buying banks in Georgia, and they wanted me to develop a plan and say, if we bought this, could we build, with what's left to buy in Atlanta, a leading market share in Atlanta? And so I came up with a plan, and I said, you can't be the biggest bank in Atlanta, even if you bought up just about everything that was left, but you could be the biggest bank in the best part of Atlanta. And I drew up this strategy, and they liked it. As was the case, it's not as they didn't vote down every idea I've ever came up with, because there were some acquisitions that we did, but they tended to be relatively small. They decided not to do it, and First Union, it's almost like they had my plan. It's
wow.
like, so somebody up there had the absolute plan, and they bought all of those banks, either almost immediately. The bank in question used to be the National Bank of Georgia in Atlanta. It was First American for a while, and that was actually bought by South Trust. They didn't buy it, but they bought the other parts of First American, which were in Virginia, D.C., and Tennessee. And they also bought Georgia Federal and Decatur Federal, and which were the big part of that. And all that happened before I joined First Union, but they hadn't closed those deals. And I had thought about going a different direction, and I went and interviewed at the Federal Reserve Board up in D.C., and one of the directors at Barnett was a gentleman named Fred Schultz. He used to be vice chairman of the Fed. Mm-hmm. And I went to see him, and he said, you really should go get some Fed experience. And if you want to really get a graduate degree in economics, it's a lot easier to do in D.C. because there's a lot of schools in that area, and you can probably find time to do it. And so that was my plan. I went up there. I was very disappointed with my visit to the Federal Reserve Board. And
what were you disappointed about?
Well, it was kind of an odd day. The weather was terrible. I get up there, and I'm supposed to meet with someone from Human Resources, and I get to the guard station, and they said, well, you're going to need to wait here. And oddly enough, something like that happened to me at the Federal Reserve Bank of Atlanta, and earlier in my career, and when I was still in college. And it turned out that the person I was supposed to interview with had gotten fired the night before or quit, one or the other. I'm not quite sure, but whatever. It was very abrupt since I talked to him the night before and he was supposed to interview that next day. So I get this bad feeling then, and she didn't get fired or anything, but she had gotten carjacked on the way to work. And so and this was in 92, I guess, in 1992, DC was going through a down period. It was much more dangerous than it is today. But she comes in and she goes, tell me, Mark, what kind of car do you have? I said, a Chrysler LeBaron. She goes, convertible? I said, yes. She said, what color? And she goes, red. I said, red. She goes, you might as well just mail him the keys. And I was like, and of course she's not in the mood to do an interview that day, and she gives me a notebook and says, look through here and see if any of these jobs appeal to you. And it's a big binder, and I saw some jobs that had been posted in the 1960s. And this was 1992. Wow! And I was like, oh boy. But I went through and I would have had an opportunity to work there. I mean but when I came back and I was at a dinner, and one of the persons at the dinner was out on the board of First Union, and he didn't know I was looking for a job until I showed up late for the dinner, and then he said, well, what were you doing in D.C.? And I was like, he says, well, if you're interested in coming to work at First Union, he goes, I think we could use you, and so that was my introduction to First Union, and I wasn't quite sure. I didn't want to talk business at the table, so I went to see him on Monday, and he was right, because I went to see him. I didn't really expect much to come of it, and went to lunch after that. Came back from lunch, and I had a bunch of calls, and basically was able to arrange I went up there for an interview and went to work for them. It was a tougher time. The banking sector, we were coming out of the 89-90 recession, which was a deep real estate recession. And so banks really weren't looking to add staff. But First Union was doing something that I was totally unaware of, and until I went there for the interview, and that they were building an investment bank. They were doing a de novo investment bank. Now, some banks had bought small investment banks. First Union was doing this from scratch. Wow. And that immediately appealed to me. And maybe I appealed to them because I've always wore suspenders. And so I come in there. It was a little bit of a throwback even in the early 1990s, but the 1980s they became very popular for me. I'm just kind of short and stocky, and it helps hold up my pants. But that was a great transition, because it was before we had this big startup craze out in California, but it really felt like a startup. They were fairly relatively young people. There were new people coming in every day. You had new technology. When we opened our doors, everybody got a brand new computer, and back then they were IBM PCs, and it was the largest order ever placed at one time for IBM PCs. They had 2 tractor trailer loads of IBM PCs all get delivered at the same time. They hired a tech team out of New York that came down and worked for us. And I think a lot of people were scratching their heads like, what on earth are they doing? NCMB wound up doing the same thing. So we had two investment banks in town, and it was an exciting time. And also, First Union was a big commercial lender, and one of the ideas that I had, and something that set our economics department apart from other banks, was even when I was at Barnett, if I went down to speak to a Rotary Club or a Chamber of Commerce, I said, oh, that's really nice that you come down and you invite me down here and you meet some people. There's not much of a business development strategy. And so what I would always do with the bankers, I said, well, I'm there. If I came all the way down here, let's go visit a couple of your really good customers, go to their place of business. So I could, just like I did with that small business development center, I wanted to find out how the economy impacted their business. Wow. And because that would tell me a lot in terms of economic analysis. And then, what questions they had about the economy that I could help them with. I mean, they might wonder how, when they read a statistic, what it actually measures and whatnot. So it wasn't that I'd go down there and give them a dissertation on the economy. It was more of just a give and take.
Wow. Focusing a little bit more on First Union, but well, first of all, what made you so interested that it was an investment bank as opposed to just a commercial bank? What was the interest level there for you? What were you excited about at the time?
Well, at the time, I was thinking that at some point I might want to go up to New York, and I thought, well, this would be a great opportunity to be working in an investment bank. It'd be, once you're working at one, it would be fairly easy to move laterally. And the other thing about First Union, though, is at the time they were the sixth largest bank in the country, and I knew they were growing aggressively, and so I liked the way I liked the footprint that they had. They didn't have any publications, and that was one of the things that the head of the investment bank mentioned in the interview. And he said that we don't have any publications. In fact, we've never had one mention other than earnings in the Wall Street Journal. And I told him, I said, I don't mean to sound like I'm bragging or anything, but I can pretty much assure you that we'll get at least one mention in the first 30 days. I said, if not, I'm going to have a serious conversation with some people. But I said, I was fairly certain that we would get something done. And so, when I like the challenge, I like the company and just I also had gone in there with relatively low expectations because I knew the company, but I really thought it was going to be another traditional bank job. And the one thing that I didn't like about the traditional banking world is everything moves so slowly and it was so bureaucratic. And and that's not the way things are done in the investment banking world. And it was also, to me, it's just that the fast pace, the pace that we operated in. It was really like you would do more in the morning than you would do in a week back at Barnett, and literally I'd write these reports and we would try to get them done in 2 hours, and at Barnett we might spend a week on it.
Wow.
and that was kind of the different pace between the bank and the investment bank, and it was like, hey, it doesn't have to be perfect. And the thing about striving for perfection in writing is that it never is perfect. So you've just wasted all that time trying to perfect something that's not going to be perfect.
Wow. So being an economist at a commercial bank or even an investment bank, do you have your own freedom to kind of research at free will and see what you think of the market, or trading teams or investment bank or different teams pulling you in, of giving you different topics and say, hey, see what you think about this local market or this economy or this? How does that work?
Well, that would vary by the organization. Okay. But, and I will say, I just kind of remembered this. At First Union, we had a very unique reporting structure. In that, because we didn't have an economics department, they had an economist, and we shared administrative assistant with the head of the investment bank. It was a fellow named Jerry Schmidt at the time. And when Jerry retired, Ken Thompson, who became CEO of the bank, was the head of the investment bank. And so we shared an admin. And I met Ken the very first day that I started at the bank. He called me the very first day that I started, and then he came up to Charlotte to meet with me. But I get into this because in the investment banking world, there are restrictions on people who work in research, in that you cannot be told what to and what not to write. It's a big no-no because that there are big rules against that. And even though we weren't part of the research group when we started, we joined the research group right in the middle of the financial crisis. I'll get to that when we get to that part of it. But we behaved as if we were in that group. And when you had a small number of people, there were 2, then 3 of us, then 4 of us. Even up to the financial crisis, there were only 6 or 7 people in the entire department. we behaved as if we had to adhere to those rules, even though we didn't. And then suddenly, as the organization became larger, they were like, we can't have this. The economics area has to be in the research area governed by the same restrictions, because, even though they haven't done anything wrong, if they ever did, it could lead to some serious sanctions. So, getting covered under the investment banking laws is a little more complicated, in that you have to have everything reviewed by different people before it goes public. And there was never a time in my career that I ever wrote anything that somebody said, "Oh, you can't publish this." At least not from a compliance standpoint. There may have been somebody that said, "Oh, I can't believe you're going to publish this," but I've never published anything that caused any kind of controversy, even when we covered controversial subjects like Obamacare when it was passed. I think we got a total of 2 calls complaining, and I asked them, "Well, did you think I was too much for it or too much against it?" I was like, it's like, I think we had one that thought I was too much for it and one that thought I was too much against it. So I kind of figured it was probably done just about right.
Fair, yeah. What was the adjustment? Was there any adjustment when it evolved to Wachovia, and then when Wachovia was acquired by Wells? So I guess to focus on Wachovia for a minute, was there any adjustment?
There wasn't much of an adjustment when we became Wachovia, and First Union had done a number of acquisitions. I remember one that was done very early in my tenure there was we bought First Fidelity, and First Fidelity was based in Philadelphia, and that extended us into Philadelphia, Maryland, a little bit more in Maryland, and a little bit into eastern Pennsylvania, and then we filled in Virginia, and we bought core states, and at the same time we were trying to do something called Future Bank, which was to use new technologies in the branch to streamline, to get more throughput, a better customer experience, and the combination of those factors did not go over well in every market. There were some markets that did relatively well. In the Atlanta market, it did extremely well. David Carroll was the head of the market there, and he just did an incredible job. And maybe it's because they had a younger demographic. It did well in some parts of Florida as well, an older demographic. So it wasn't necessarily that. But in any event, the First Union name had gotten run through the mud a little bit. And then we also had an acquisition of something called the Money Store. Mm. And I understood the acquisition when it was made. I understood the Money Store concept. And
what was the Money Store?
The Money Store was they had Jim Palmer would make these ads, and it was for folks who generally had less than perfect credit, but had maybe they had a lot of debt that they needed to roll up into a consolidation loan, and they would have less onerous terms because they were a national brand than other lenders in that group were. And the risk of buying them was how the regulators would view accounting for those loans, particularly when you get into the business cycle. And there may have been some fraud. I'm not exactly certain exactly where it was. It wasn't my area to look as closely in there. We did do a couple of things with Money Store. It related to the economy, but it wasn't that long after we bought them that they nearly wrecked the company. And so First Union was on the ropes a little bit. Mm-hmm. I worked with Ken back then on ways to raise capital. We had to sell off some assets to right the ship, and so when we merged with Wachovia. It was probably one of the best bank mergers ever done. And ironically, we patterned that merger after the Norwest Wells Fargo merger, wow. which Norwest bought Wells Fargo and took Wells Fargo's name because Wells Fargo had bought First Interstate. They did a misstep, and they they had a great name, but they had done a misstep. Well, First Union, had sullied their name, and the Wachovia name was, certainly one of the best names in banking, and so there really wasn't much change. They didn't have an economist. I think Wachovia was probably a little, from a personality basis, they were probably a little stuffier than First Union was in terms of they were a little more stodgy, but not overly so. And I think that from everybody's perspective, the merger was very smooth. The investment bank grew very rapidly. We weren't a source of the problems in that we were kind of we were actually the big profit generator at that time when we were going through that period. So there were no cuts there, and so we came through that transition, relatively unfazed, other than having to say we worked at Wachovia instead of working at.
Right.
And ironically, shortly thereafter, that merger went really well. South Trust approached Wachovia and said we would like to join up as well. So I mean, it was actually because the merger went so well, South Trust and they were part of the plan. And I told you they bought the other part of the First American that First Union did. And so psychologically for me, I looked back and said, wow, now my entire plan is in place here. And in First Union's, and I grew up in Atlanta, so I like the fact that we had become the dominant bank in Atlanta. So it was
absolutely. So interesting time to be an economist in your Wachovia days. So the Wachovia merger happened in 2001-ish?
It happened in 2001, and actually it happened, took effect September 1 of 2001.
Oh, wow.
So I remember that because one of the very first places I wound up going, and under being in Wachovia, was our trade association was meeting in New York on the conference concluded on September 11th, and so I happened to be in the Marriott World Trade Center, which is connected to the North Tower on September 11th. So it was but it was unrelated to the merger, but it was my first official trip. In fact, I had a brand new laptop, which I probably used 3 times, but I wasn't going to go back up into my hotel room and try to get it. No, it's like
wow, what a crazy time. So what was your role in your life like then, 2001 through 2008 until Wells Fargo acquired? You have a real estate market that peaked in 2005 or 6, but super robust, building tons of development, especially in the Southeast. A lot of condos, a lot of sellout, everything's pretty good. And then
it was great. Wachovia was the number one real estate lender in that time, which was great during the boom. But we were the number one lender to the home building industry, and I did a lot of work with the home builder group, and I still do some work with I still do a lot of work with home builders. And but we also were the number one bank in commercial real estate, and there was a lot of real estate being built in the South, and we had a lot of that. We had a conduit in the investment bank, and so we had a really strong commercial real estate group, as did at that time it was Bank of America already down the street, and the real estate lending was so strong between the two of us that this was one of the hottest markets. Charlotte was one of the hottest markets for lawyers, and so the early O's were just a boom time for Charlotte, and it knew that those days couldn't last, and I tell people that it was great. I traveled a lot. We were publishing regularly on. I would publish reports on commercial real estate, a quarterly on commercial real estate. And a monthly on the residential market. And we wouldn't update the forecast every month, but we would publish a report on it every month, in addition to the economic indicator reports. And it was a great time. It was hard to see how much speculation was going on at that time. And it didn't start that way. It was almost a perfect storm in that after 9/11, there was a nesting instinct that took over the American people, and we were staying home more. And so the demand for for sale housing really took off, and it took off ahead of new construction. And so the first couple of years, I'd say 2001 to 2003, it was all fundamental demand. But because home builders, demand was ahead of construction, prices were rising so rapidly that people were actually out there getting credit card offers, which I think the industry sent out 7 billion credit card offers in a year. And so people would get 5 or 6 credit cards, and then they would buy 4 or 5 homes where they only had to put down $2,000 on each one. And then hopefully they were, from their perspective, they were going to flip them before they were even completed, and before they would need to actually outlay any cash. And and it was hard to believe how much of that was going on. And I wrote a report kind of in the immediate aftermath, and I said we should have seen it coming, and we did see a lot of it coming. But there was an article, and I said I don't usually use USA Today as a source, but they were interviewing someone who had wanted to retire to Orlando, and so he bought 2 houses, thinking that he would make enough to appreciate on the one that he could pay off the other and live there for free.
Brilliant.
And I thought, there's no such thing as a free lunch. It's the number one rule that we learn in economics. It's like I just said, oh my goodness, this was just terrible. But to me, the most frustrating thing about getting into the financial crisis was that we had a pretty good handle on it. We developed a model that we knew how much home prices were likely to decline. And we were definitely in the ballpark, because I think the model said about 34%. We knew how much home building was going to decline.
And you were reporting on that?
At the time, we were. From 2005 to 2007, I think the market probably peaked around March of 2005. The one thing that was impossible to forecast was the interconnectivity of housing and securitized lending, and people just wondered how much bad stuff there was in there, and they just assumed that it was all bad. And it's, we're numbers people, and we look and say, okay, how big is subprime lending? It's $360 billion. Let's assume 25% of that goes bad. Mm-hmm. Well, that's not as bad as the S&L crisis. So wait a minute. So why on earth? Sure. We looked at it, but that you have to look at it in kind of a worst case thing. And what happens? Everybody else assumes, well, how much bad stuff is there in the credit card portfolio? How much stuff is there in the commercial real estate portfolio? And in hindsight, there really wasn't that much bad stuff. It really was a problem that was related to residential. Right. And so it was very frustrating from that standpoint, because you weren't going to be able to sell that. And then ultimately, Wachovia had made an acquisition of Golden West Financial, which was out west in California. And it basically we had a small bank out in Southern California already, so we were a coast to coast lender. But Golden West was a very unique company, and they only had one residential loan, which was something called a pick-and-pay loan. And it was really something that was geared for the California market, where people had a lot of commission income, or they had a lot. Maybe they worked in the motion picture business and they only got paid once a year. And so the way the pick-and-pay loan would work is that you would you could make minimum payments, or you could actually take money out of your house. And
what was the original loan size of it? Like, if you went to get a pick and pay loan, the house costs $400,000 or $500,000. Like, what leverage would they give you on a pick and pay?
I'm not quite sure as to if it was, but it was probably 80%. Though. Okay. It was probably, and the problem is that we had a big decline in home prices, particularly in the Central Valley. Mm-hmm. So if you were closer to the coast, the prices held up relatively well, and so that wiped out all of your equity. And ultimately that product held up better than people thought it would. And one of the things that I had to do, which was just kind of an odd experience, is I had to go out and meet with the Pick and Pay customers right in the middle of the meltdown.
What was that like?
Well, I remember when I met I had a driver, which was not something that was typical for me, and he introduces himself and tells me he's with Wachovia Security, and I said, well, which part? And he goes, security. I'm your security guy. So we had a bad situation yesterday. And he said, not at our event, but at another event. And so you're going to have. And I said, I'm going to shadow you and drive you around. And
No way.
And so I was like, oh, great. And it was a Saturday. So I'm like, all right, I had just finished a whole week traveling around the country, and I'm here on a Saturday. And so
you're going door to door?
No. We were in. I flew from. I was in Orlando for a banking conference, and then I flew to Burbank, California from there to go speak to the Pick and Pay customers. And we were trying to convert them to conventional mortgages and get them off our books. And that way, and so we could raise capital. And I sat there, and like I did with businesses, I asked them, I said, tell me, why did you get the loan, and has it worked out the way that it did? And because I went in there and talked about the economy, and I said, well, these guys aren't that interested in the economy right now. I mean, there's a lot of things that, they're living it. They don't need me to talk about it. And so when I talked to him, he said, well, Mark, he says, you guys get this all wrong. He said, none of us, he said, we don't want to convert to a conventional loan, and we're never going to let this loan go bad because, after this, everything's going to be documented. And if we had to document our income, they'd throw us in jail. I said, and so it began to make sense to me that okay, a lot of these guys are working in the gig economy, and they're working off the books, and so he's right, and ultimately the Pick and Pay portfolio held up relatively well, because if folks said, if I don't keep this mortgage current,
I'll never get another one.
Right. And so they weren't worried about their house being upside down. They were like, and they also understood that in California, you don't have to, you can just have some introductory economics to here, that you have the housing operates under a very inelastic supply curve. Mm-hmm. It's very hard to build in California. And when you have an inelastic, which means it's a very steep supply curve, it means that small changes in demand give you big swings in price, both up and down.
Right.
And they all understood that without even having an economics class. They understood that, hey, this is the way California is. Prices they go way up or they go way down, and we just have to ride it out. And I left there reassured, but I said the regulators they're not going to buy that at all. They're going to say, prices are going to be down 25%. And it might take 10 years to recover, and that ultimately did.
Yeah. What changed when you went to Wells Fargo? We can walk through the Wells Fargo time period, and then I want to spend some time on Piedmont as well, because it looks like you're doing some pretty exciting stuff.
Yeah. Well, that period of time when I was talking about Burbank, that was kind of like the week
the
of
bridge.
it was the we knew that Wachovia was in trouble. I really didn't think. I thought that Wachovia would find a way to come through the crisis. But in early August, somebody had handed me a piece of paper, and I couldn't tell whether it was true or not, and talked about how the FDIC was going to try to sell off Washington Mutual and Wells Fargo, mainly because they were so deposit rich that if they were to have a run on those institutions, it would threaten the integrity of the FDIC insurance fund. And I wasn't sure if it was true, and so I just I dropped that and on someone else's desk and said, I was handed this. I don't know if it's true, but I don't even want to look at it, and gave it to someone in our legal department and that I knew, and just stepped away from there. But from there, I was a little nervous, about what was likely to shake out, and then there were other times I was called. I got a call from a reporter that said a source in Treasury had told her about we were in trouble, and I basically kind of walked her back from that a little bit, and went to talk to our CEO. One of our large customers had taken lots of money out of the bank. I can't give you the figures without maybe giving them away, but they, you're talking about hundreds of millions of dollars, and
in deposits.
Yeah, deposits, and it was buying T-bills, and he had asked me to come out and have a drink with him, and I said certainly, and I thought his fears were irrational, and he's like, I don't think so. He says. And then he finally said that the reason I asked you for a drink is I want to make sure you're going to be okay. And I was like, oh boy. And so I remember I came home and I called our CEO, Bob Steele, and my wife was like, don't call him right now. Don't call him right now. He says, you've had something to drink. I was like, I had a drink. I'm going to be okay. And I call him up. He says, come up and see me in the morning. And so and so I got an idea of where we were right then, this kind of brought under the tent a little bit in terms of the idea that we were probably going to sell the company. That wasn't our first choice, but we were probably going to sell the company, and there was a good idea that we were going to sell to Goldman Sachs. And Goldman Sachs, the deal was very, very close. I mean, I would say within 15 minutes. I mean, I think that the CEO was in the car from Teterboro headed into the city, and what kept that deal from happening was that the Federal Reserve allowed Goldman and Morgan Stanley to become banks and access the discount window, granted them bank charters. It was I'm not sure if they were granted bank charters, but they got access to the discount window, so they didn't need to buy us anymore. In hindsight, that would have been a great acquisition when you think about how Goldman Sachs has had trouble with Marcus.
Yeah.
And they didn't know what the extent of the issues were at Wells, but at Wachovia, in any event, when that fell through, there was talk about doing a deal with Morgan Stanley or doing a deal with Wells, but still there was no actual deal on the table. But another week goes by. I don't want to overstate my importance in all this because there are a lot of people that are really maneuvering things. But kind of one of the odd things that happened was Sue Myrick, who was our congresswoman from our district, had called me, and it was on a day where TARP was being talked about, and I was in a meeting room, and I can't even remember what the meeting was about because I remember I was in the meeting room and thinking, I don't know that I have anything to add. And I thought, well, maybe they've got me in this meeting because everybody in the meeting knows the situation of the bank and they don't want me out on the floor. Sure. I mean, I couldn't figure out what I was doing in that meeting. And so then I get a knock on the door and it says, Congresswoman Myrick is holding for you. And so I said, okay, well, I take the call. And she asked me what I thought about TARP. And I said, and I figured that she was calling because she knew what our situation was. And I said, well, if you guys can vote on this today, if we can get this done before the markets open on Monday, then I think we've got a chance. And she goes, who's we?
Boy.
And I was like, so I was like, oh God. She goes, are you guys in that serious of trouble? And I'm like going, I can't say anything else. I'm sorry. I said, I just really walked into it. And so I kind of, I don't know how we get off the call, but we get off the call and I'm thinking, oh boy. And so, but she told me that she goes, we're not in session. I'm home right now. She goes, we're out. It's Friday. I'm here. And so, I thought, oh boy, well, we're in trouble. And so I didn't tell her that, but I was, I'm thinking in my mind, we go through the next week and, not much happens that next week, publicly, but on Thursday is when J.P. Morgan bought Washington Mutual, and they didn't provide immediate guarantee for the bondholders.
Right.
And there were questions about some of the depositors as well. And that happened late. It was weird because usually a deal like that's done on a Friday. Mm-hmm. And I remember my wife and I were going out that night, and we were going to Sullivan's Steakhouse, and we go to Sullivan's, and Sullivan's is just packed. And I'm thinking, I'm walking in there. It's like, these people don't realize how much the world's going to change tomorrow.
Oh, wow.
I'm sitting there. It's like, almost felt like I was at a funeral. And it's like, people just don't realize.
No one else knew.
People don't realize how much things are going to change. And so I knew that Friday was going to be a rough day. I didn't know that we would have the essentially an electronic run on the bank, and the stock price, I think, closed that day at $10. So I think we went from like $20 to $10 a share. And as it is, my wife we have a cabin in the mountains, and my wife was going up there with her book club, and I was taking care of the kids, and so I had to leave work early to go pick up the kids, and it was a very weird time, and I've got people calling me, and I can't talk to them about things, and they're asking me things about the bank. I can't say anything, and knowing my personality, the fact that I'm not saying anything, I know that they're scared.
Of course,
scared to be. They're like, "Oh, things must really be bad." And I'm thinking, I'm like, "No, I've just got to go. I've got to go pick up my kids." And so, and I will tell you that with my personality, there was one time I did a national public radio interview while I was dropping my kids off at preschool. So I said I'd forgotten that I had to drop them off at preschool when I agreed to do the interview. So it's scheduled. And I says, Dad's got to have to do something, and you guys are going to have to be very quiet. Wow. And so I was doing that interview from about where the museum is on Randolph all the way to the JCC. And somehow I was able to pull it off without the kids saying anything. And my wife I think she was traveling somewhere, and she heard it, and she goes, "I can't believe." She goes, "I know you had to be in the carpool line."
That's hilarious.
But so that's kind of my, I was so when people are saying you've got to know something, I'm like, "Oh, no, I can't say anything." And so we went into that weekend, and that Sunday, I got a call from a friend of mine at CNN. And he told me, what was going on with the negotiations. And he said, "Listen, I guess I'm not calling you for any comment, and I don't want you to comment. Just listen." And he said that my understanding is that Citibank and Wells Fargo are the only two people that are in negotiations, and that Wells Fargo's walked away. So it's just Citi right now, and so it's either going to be Citi. He goes, "You're either going to." He says the way it stands is you're either going to be Citibank or Bridge Bank, a unit of the FDIC, tomorrow morning. So just wanted to give you that heads up. And so and I thought, wow. I said, this is kind of a shocker. And so, I didn't say anything. I call up, it's Sunday. There's only a few people in the office, but I know who's there. I said, anything going on? And because that next day I'm going to speak to a group of clients at Reynolds Plantation in Georgia, many of which had sold banks. Some of them were small, some of them medium, some of them large, to First Union and Wachovia. Wow. And I said, wow. I said, this isn't going to be a pleasant group. And so I called and talked to folks in the corporate communications area, and they said, so you've got the right information. And even though Wells has walked away from the table, they may come back, and somebody else could come if they wanted to, but it doesn't look like anybody else is. And so I drive down to Reynolds Plantation. It's 3.5 hours or so. And I get in there, and a couple of guys are at the bar. The bar's just about to close up, and so the guy asked me, he said, "We're hearing all sorts of crazy rumors about the bank." And I said, the crazier they are, the more likely they are to be true. What
did he say to that?
He said, he just got this blank look on his face. And I said, "Listen, let me go put the stuff in my room, and I'm just going to call the office real quick, and then I'll come back out." And so I go, and I come back out, and he's got a drink on the bar. The bar's closed then. And he goes, "Who's in the office at 1:45 on a Sunday night?" It's Monday morning. Yeah. And I'm like, I said, a lot of people. I said, and at that time, I could tell him, because I could tell him what I knew at least. And I said, we're not going to open up as an independent company tomorrow. We're going to be either Citibank or Bridge Bank or possibly Wells Fargo. But so far, I haven't heard anything about that. And
wow.
And so I said, I got to get to bed because I've got to get up. I'm going to get up at 6:00 to get the
to see who you work for.
Yes, to see what's going on, so that I can talk about it in front of the group too. And because they're supposed to send me a deck as soon as available, so I get up at 5, and I'm looking at 5:30, looking at 6. There's no deck, and I'm thinking, maybe it was all a bad dream. Maybe things. But then finally, it was Citibank and $1 a share. Remember, that was the initial. And so my stomach's sinking, and I'm thinking, this is not a very good outcome. And I was not. I kind of felt it was the worst possible outcome because, in my view, Citi doesn't know much about running a retail bank. They're more of an international bank. They're probably not going to see the benefit of having our investment bank, and it just seemed very odd. And they didn't want to buy the retail brokerage, but I didn't see how you could separate the retail brokerage from the company because they're pretty integrated. And so it troubled me, and I went there and I gave the presentation, and at the last thing I said, who knows? I said, this thing seems a little weird to me, and I just talked from my heart and just said what I thought, and I said, who knows? By the end of the week, we might sell Citibank, and something that the line didn't even make sense. Really, how could we sell Citibank? But we might. But I meant the whole thing could come undone, and so. So I give the talk. I drive back to Charlotte, and I'm feeling a little odd. My wife we had 3 children, and after the third, she decided she wasn't going to work anymore. She was doing very well, working as an investment banker in municipal finance, and I thought, oh wow, what a time for this to be going on. But on the way home, I got 2 calls. Asking if I would be interested in coming to work at their organization. And I was like, well, it's a little early for me to make a decision like that. I said, but on one of them, I said, but certainly I'll come and talk to you at least. I mean, there's no harm in talking, and maybe there is a good fit there. And so I kind of thought, well, that's kind of interesting. And then I get back, and I had to go to Australia in a couple of weeks to go visit clients in Australia, and it was something that was planned way before the financial crisis. And one of the things that I did at Wachovia was that I would try to touch every aspect of the company. So that would mean each year I would do at least one international trip. Right. Well, in 2008, with the economy weakening, we were told early on that we need to cut something out of the budget. So I said, well, cut my international trip out. That's an easy thing. Very next day, the CPA Association of Australia called and said, we would love to invite you to come speak and give a talk in Sydney and in Brisbane. And you would have days in between, and you could do whatever you want. You could tour, you could go visit clients, whatever you want to do. And I thought, well, never been to Australia. Yeah, that way I can still still meet my objectives, because the way a big bureaucratic bank does is that they'll take something away from you, and then they'll dock you for not meeting your objectives. And so I thought, well, this way I'll sneak it in there. And so I had that coming up. So when I get back to Charlotte, I decided I'm going to go run to the Apple store and buy a big Mac, so Macintosh computer, and told my wife, I said, you might want to play around with this, maybe even create me a resume for me or something, because oddly enough, I didn't even have a resume when I came to work at First Union, because it was all done through conversations. I didn't have a formal resume, and so I said, you might want to make a resume. Who knows? I might need that. And it's first, I said it wouldn't hurt to learn some skills on this Apple. And I went to the Apple store. I'd never seen. That's the one thing at the mall that is always packed. I was the only person there, and the salesman actually carried it out to my car. So you don't get that kind of treatment. There was nobody there. I'm going to walk you through this whole week because it's kind of an incredible week. Tuesday's Rosh Hashanah. We had made a donation that was small by the terms of major donors, but major by the terms of our donations. Sure. And so we were seated on the bima. So we're looking out at the entire congregation throughout the whole service, something that's kind of rare, kind of weird. And I remember telling the rabbi, I said, can you say a little prayer for the financial sector? I know it's not exactly what we do on Rosh Hashanah, but I mean, we definitely need a better year. And she said, yeah, I think we can do a little something there. It's like, because I'm not the only one that's hurting in the room there. And then on that Wednesday, I have got a CNBC interview at 6 o'clock. And, corporate communications calls me and they said, we're assured that they're not going to ask anything about the merger. And normally when I would do a CNBC interview at 6 a.m., nobody would be there except for the technician that ran the camera. So we're doing it right off the trading floor. So it's an empty trading floor behind us. I mean, I generally got into work before 6 a.m., but only a handful of people got into work that early. And so this particular day, there's all these people from corporate communications. And I'm like going, listen, I know Joe Kernan. He's going to ask that right off the bat. Yeah. And so I kind of had some ideas in my head. And I said, well, because that's exactly what he let it off with. Well, Charlotte, Citibank, Wachovia. So it's like, that was, wasn't even a question in there. He just kind of threw it out there. So,
this is live.
This is live. So, it's always live on CNBC. I don't think I've ever taped anything with them.
Right, of course.
But so I said, yeah, I said, Joe, I said, this is not the way I thought we were going to get there. But I said, it's an election year. And I said, we're going to be number one bank in Florida, number one bank in New York, number one bank in California, number one bank in Texas. I said, if this was a presidential campaign, we'd win this thing.
Right.
And so I kind of went with that, and I threw in a line about how I would still be there for their 6 a.m. interviews because I'm going to work for Citi, the bank that never sleeps.
That's right.
And so I just kind of left it at that. Then we went on and talked about the economy. Okay. So no harm, no foul. I've kind of learned how to do those things on the spot without doing something that's going to cause me big problems. Well,
so that's Wednesday morning.
That's Wednesday morning. Yeah, that's before anybody's even gotten to work yet. And so I get a call from a friend of mine at BB&T, and he's like, "Hey, can you come by? And a few of us are going to have lunch today over at the City Club, and just kind of give us an update on what the heck's going on." And so I said, "Sure." I said, I can do that. I mean, normally I'd probably say no, but on that Wednesday, the bank. I mean, everybody. A lot of people were not at work. It was a really weird day. I mean, people were. Or if they were at work, they were working on their resumes. And so I said, sure. I said, I can do that. And I said, so I go over there and they have a big crowd. And I kind of went down as to what was going on and, how I felt like we were going to be going through a real deep recession. I said something that would be, akin to 81, 82 or 73, 75, kind of those two downturns. And that, typical recession lasts 9 months. This one was probably going to last 18. Turned out it lasted 19, so it was 1 month longer. So it was kind of in that ballpark. And, it kind of went through all that. And then as I'm leaving, I run into the CEO from Bank of America, who we had been on a program earlier. And he was wondering why I was talking to BB&T and Ken Lewis. And we just chatted for a few minutes, but so I thought, oh well, that's kind of cool. And then I go down and get back to work, and we chatted a little bit. He says if because he said something. It was kind of a throwaway line, but something like, "Hey man, if this doesn't work out, come see me because I mean, you're going to be fine and all this." And I was like, "Yeah." I said, really, it was a friendly lunch just to bring him up to date. And I come back to the office, and there's this message. I have an old administrative assistant, and she doesn't necessarily write things very clearly, okay. And but she's great. But and I said, well, who is this from? Is this a reporter? It's somebody in New York. And she didn't know. She said that they had a heavy accent, and she couldn't tell. And so I call up, and it says executive offices, and I'm like, at where? And she goes, Citicorp. And I was like, oh, and that's like, so I've got this message, and I can't make it out. And she goes, and she goes, Vikram Pandit. And I was like, oh. And so Vikram Pandit had seen the CNBC episode, thing earlier in the morning. He was calling to comment on it to me, and he said that they shared it on the executive floor, and so I talked with their chief administrative officer, and so I do all that, and then he says he asked me about the mood on the floor, and I told him, and he told me, you don't have to worry. He says. And he said, that I was going to love it in New York. I remember him saying,
"Oh, wow!"
And I was like, well, you might want to ease up on this kind of conversations, because I said I said all of that is not permitted under the rules. I mean, we can't supposed to talk about things like that. And because I've been through a lot of mergers, and I knew you're not supposed to have that kind of conversation. He goes, and I was like, okay. And it's like, and I said, and I thought about it. I said, well, everything they told us so far was that we were going to be right here in Charlotte, so. It was a little unnerving from there. From there, I went to an emergency city council meeting.
All Wednesday night.
This is all Wednesday night. On Wednesday night, emergency city council meeting, and from there, I had a car service pick me up from there to get me to the airport, because I needed to go to Dearborn, Michigan, to talk to producers of they produce things that go onto trucks like snow plows. Things like garbage trucks lift things up. They do all of that kind of equipment. Very specialized group, but something I did every year. And these were all classic middle market customers, kind of a sweet spot that we banked. That a lot of these companies would even be small businesses. They were family owned businesses. Mm-hmm. And when I got there and talked with those guys, I mean, you really could see the distress in their eyes, because they couldn't borrow money. Their customers couldn't borrow money. They couldn't issue, because a lot of the cities and counties that bought the stuff from them issued certificates of participation. That market was totally dried up. So they weren't getting paid for things they had already sold.
Right.
And they didn't have any cash. And you could see the fear in their eyes, because it's a business that they built their entire lives. Mm-hmm. And so that really struck me. And I knew, we were in, as to what happened there. Fly down to Orlando to speak at a banking conference, and I thought, well, the timing on this wasn't great, but I'm here, and who knows what kind of, it's always great to have those contacts. And I'm at down at a golf resort, Bay Hill Golf Resort, great place to be. I'm speaking on Friday. I get down there Thursday afternoon, Thursday evening. That Friday morning, I'm writing the weekly commentary from my hotel room there at Bay Hill. And I get a call, and it's Sue Myrick. And on that Friday, Wells Fargo had announced the deal. They announced that they had come to, they were going to offer a higher price for Wells Fargo, for Wachovia. And Citibank was making some noise then. And they were going to vote on TARP again. TARP had been voted down that Monday, and Sue Myrick called and said that she had 15 other congressmen that had voted no in the office, and that they were all looking for a reason to vote yes. And she said, you had articulated a reason to me a couple of weeks ago, and I was hoping that you could do that to the group. So I didn't remember what I'd said, because that was so crazy week. And so I started talking about it, and somebody said, we don't have time for this. I said, Mark, this is the deal. We all know we have to vote yes. We need a reason to that we can say, because we've just been told that at 2:00 this afternoon that 1/3 of the Fortune 500's payroll checks aren't going to clear because they can't issue commercial paper this morning. Wow! And he says, if we don't vote by 11:00, we can't. That's not going to happen. And I don't know if that story was. I don't know if what they were told was actually true. I think that Hank Paulson probably was exaggerating the threat, but whatever, they all believed of it, and this is hindsight. At the moment, I believed it was true, and so I said, I've got it for you. Just blame it on me. Tell them I scared the hell out of you. I said, Congressman Myrick knows. I said I was in the Trade Center in 9/11. I said in 9/11, when the first plane hit, we didn't know what it was, and we kind of felt that, at least I felt that. Whatever it was over, and we were okay. And so it was just a question of getting out of the building. And we got, because I was on the first floor, I came out in the lobby. There were some spot fires around, and I could see that a bus was crushed outside the building. So I assumed that it was a bomb in the bus that had gone off. And And about 20 minutes later, we got out. I ran across the street, was able to call my wife from a delicatessen. Back then, we didn't have cell phones to the extent that we do now, and that's when they told me it was an airplane, and I was doing an interview with I didn't know it was an interview. I had my name tag on, and there was a guy who was right in front of the Wall Street Journal building at the time, and the guy asked me what I thought, and we were talking for a minute, and that's when the second plane came in, and this is what I told him. I said when that second plane hit, that's when you saw the fear in people's eyes, because they didn't know what else was coming. And I said, that's where we are in this financial crisis right now. People don't know what else is coming. And I said, I don't know if the $750 billion package is the right thing to do, but it's the only thing that we have on the table. And I think it will convince people that we have a plan to deal with whatever else is coming. And so front page of the Washington Post the next day, it said Sue Myrick and 15 or 16 other congressmen switched their votes from no to yes, and TARP passed as after they talked to Mark Vitner, senior economist at the failing Wachovia Bank.
Wow.
They had that as after he told them that he hadn't seen fear in the eyes of business people like this since 9/11. But it's a long story to get to that point. But I mean, this is how meeting with those businesses is so insightful into everything else you do. I mean, I'm not making this stuff up. I saw the fear. I saw the fear in their eyes, and I just conveyed that message to them, and it had an impact. And without that, I don't know that we would have gotten TARP through. And it's kind of it was kind of cool when my kids were studying the financial crisis years later. I said, "Yeah, I can show you what your dad did."
That's awesome. So how did the Wells Fargo deal finalize later that week, or did it take longer?
Well, it took a while for it to be finalized, but evidently what had happened, and I found this out, is that Dick Kovacevic had made an offer off the cuff for Wells Fargo right after the Goldman deal fell through, and he didn't have the permission of the board to do that, so he had to say, "Listen, that was that's not a formal offer."
Right.
I'm not 100% sure how this worked, but evidently after the Citibank deal was done, Wachovia could not solicit new bids. But since Dick Kovacevic had already verbally made a bid, he could amend that bid.
Interesting.
And so they amended that bid.
Where did that bid land at? So
I think
it was at $2 a share?
I think it was $1 a share, but
I think
it was $1 a share, because I know we were trading under $1 after it was announced. And when you did the analysis because they were only buying the bank and the investment bank, they weren't buying the retail brokerage, which was the largest in the country, and a very successful retail brokerage. And when you did the numbers, the value was $6.50, and that's essentially. I think Wells may have bid $7. Came out with $7. The number that I understand that Kovacevic is kind of out of his, just saying I could, envision a number around 14. I think that's what he originally had thrown out there without looking at the books or anything. Yeah. And it was just such a compelling match that I think that Wells was like, we're never going to get an opportunity to build a company like this if we don't do this. Mm-hmm. And that merger worked very well. I felt that we were fairly assured. Wells did have a couple of economists, but they were scattered about, and they didn't really have an economics group. And we incorporated them into the group that we had in the economics area. One of the odd things that happened, as I mentioned earlier, is that we had to come under the research group. And lo and behold, when I took my Series 7, I guess, or whatever it is, the exam that you take, where it's basically something to be a stockbroker, even though I'm never going to sell securities unless I start something else up. But I took that on September 15th of 2008. That's the day Lehman failed and Bank of America bought Merrill Lynch. I scored fairly high on that exam because I was trying to get it over with so I could get back to the office, and I had to take it in Winston-Salem, so I had to drive all the way back. And it was so I actually scored fairly high. I mean, usually you just want to score whatever you need to get it over with, but it was we were well served because since we were in that environment within the research group, it made sense to fold their people into us instead of, so the group remained in Charlotte, and it was pretty smooth from our perspective. They didn't have an investment bank. They liked having an investment bank, focus on real estate. I think that Wells was a large real estate lender, both in residential and commercial lending. And they also did it very well, mainly because they tended to stay ahead of the cycle. They took risk early, took risk off early. And from that perspective, they tended to do an incredibly good job. So it was a great merger, and things. I think that from our perspective, I remember in some of the integration meetings. I was in Portland, and David Carroll was there at the meeting, and he asked one of the guys why I was wearing a certain badge, and it was different than his. And one of the guys from Wells said, well, that's because Mark is legacy Wells Fargo. and David Carroll had known me from my earliest days there. He said, no, he's not.
That's hilarious.
So I was able to fool them right from the day one, I guess.
No kidding. So how did your career evolve? I mean, that's so much just to get to 2008. So then we have 2008 through 22. Interesting recovery period, obviously, through real estate in the stock market, short like the next bunch of years, and certainly in the Southeast as well. How did your career and your focus evolve at Wells for the next 14, 15 years?
Well, we continued doing what we were doing. The department got bigger. One of the things that I started doing after the financial crisis, I kept wondering what we were missing, and so I took it upon myself to start reading books. One that I would philosophically agree with, and one that I didn't. And there are plenty of those. So I tried to do that every week, and I did that probably for 4 or 5 years, where I just read a ton of books that to get that out of to get that other perspective in there. I also started publishing 1 or 2 papers, academic papers, each year. Which is something that there's not that much of a mix between business economists and academics, but I started going to the AEA conventions and the Western Economic Association, sometimes the Southern Economic Association. I felt that I needed to broaden my skills a little bit, and it's interesting to see the difference there because. I remember talking to one of my old professors, and he said, Mark, you're doing this all wrong. The way you do it is you write a paper, then you improve it, and you improve it. And he says, you've got like a lifetime's work already. What you write it? And I said, well, the way I do it is I see a problem, I write a paper, I basically go about it the way that you guys taught us to do it. And, I have a null hypothesis, and I try to prove it or disprove it. And, I said, that's what I do, and then after I figured it out, then I move on. But it was great in terms of getting things published. That was something that I had to do pretty much in my off time, though. But we had a bigger footprint. I mean, we had a much bigger footprint, and so one of the things that I did that I agreed to do was to serve as the economist for the California Chamber of Commerce, and I did that for 3 years, which was a not a huge job, but basically I would coordinate. We had a board of economists, and we would coordinate our forecast and produce a quarterly forecast. I told them, I said, be happy to do it, but unfortunately, I can't publish something that has other. Because I had to publish it because it's going to be published into the public. It had to meet our research guidelines. Right. So I said, so if everybody else is okay with that, I said, that's the way I would do it. And so I wound up doing it for 3 years, which was, from my perspective, was pretty good. I found out very quickly is they thought that I was in San Francisco. They didn't realize that I was in Charlotte. And that my objective whenever I would travel around the system is I wanted everybody to believe that I lived in their community. So I would study as much about their community as possible. Mm-hmm. And, the technology's evolved that makes that easier today. But one of the things that I would do that would help me is I would listen to the traffic reports. So I would listen to traffic reports in Denver or traffic reports in San Francisco, or I'd go on TV and watch the news reports so I would know the names of the suburbs. I didn't get it 100 in the pronunciations. I didn't get it right 100% of the time. I mean, sometimes I would mess it up, and I would always beat myself up. I was like, gosh, how can I miss that one? And it's like, or sometimes I knew it and I still mispronounced it because, because I learned it the wrong way the first time or something. But I did little things like that so that I knew their market and the sub-markets and everything. It's very important in commercial real estate because, if you come in to Silicon Valley and you're talking to real estate investors, and you're like, what does this guy from Charlotte know about our market? And in reality, it's like, where do you get your information on your market? I mean, you get it from real estate firms, you get it from the Business Journal, you get it, you look at what's happening with leasing activity. But, in order to put it all together, you really have to understand how the market is connected.
Yeah.
What the main thoroughfares are. And so it's interesting. I mean, I don't know how many other economists, I've never talked to anybody that said, I listen to traffic reports to help me get an idea of what's going on with it.
There was one question, I don't know if you'd be able to recall any off the top, but similar to that, what other nuanced, whether it be market indicator or nuanced kind of research avenue, do you think that you did that was in this traffic reporting sense a little bit far-fetched or very unique or niche to you? Is there anything else that even market correlator of ice cream sales related to? Was there anything you thought was interesting?
One of the things that I always looked at and still look at today is airline revenue passenger miles. And I break it out domestic and international. And it has a real high correlation with GDP growth. And the decision to make a business trip it's a business investment decision. I mean, you're like, okay, I've got time, I've got expense. What I think the payoff's going to be on there. So it is highly correlated with GDP. Yeah. But you have to, you do have some disruptions in there. I mean, we had 9/11, we had the global financial crisis, which really kind of blew it out of the water in those perspectives. But it is a very timely indicator, and it's much easier to do now because we don't have a dozen airlines like we used to.
Yeah, right.
But But that's one that I've done, that I've looked at very closely. And I've also been a big follower of private data. I've always liked the Institute for Supply Management survey. I think the manufacturing survey is very telling. And I think it to me it was Alan Greenspan was probably the Fed chair that seemed to have the pulse of the economy better than just about anybody else. And now he was one that he gets a lot of blame for the financial crisis too. But I think that his pulse on the economy was really good because he was a real data junkie. And I remember I was back at Barnett when he became Fed chair. And someone had asked him what his favorite economic indicator was, and it was the what was called the National Association of Purchasing Managers survey, which is now the ISM. And he said he liked it because it was private sector. It came out the first day of the week, and it was pretty straightforward, and it seldom got revised. Mm-hmm. And I remember I just listening to Greenspan, reading his speeches, listening to him when they weren't as visible then as they are today. And I created a folder there. I just said, where with things that he would watch, and then I would start thinking about other things to watch that would be similar, that would give us clues on the economy. And the thing about the ISM and what a lot of people misunderstand is they think, manufacturing is not nearly as important as it used to be. And I was like, well, it doesn't employ as many people. Its share of the economy is holding relatively steady at around the same. And I said, but when you look at the cycle, when you look at the ups and downs of the economy, it's manufacturing, construction that account for a disproportionate share of that. I mean, you can throw in business investment and capital equipment too, but I said when you think about it that way, you're looking at the things that really change, whereas most of the rest of the economy is on autopilot. It doesn't change that much.
Yeah. Wow. In wrapping up your time at Wells or going through towards the end, towards when you leave, did your interest change at all in what you were fascinated in research? Like anything in particular that you became more focused on or more interested, broadly speaking?
Well, as we got larger, we got more
publicity.
We had more publicity, but we had more. Things got more sliced up, and that you had your own areas that you stuck to, and so I did a lot of regional analysis, and the regional analysis was because the demand for real estate is derived from the underlying growth in the economy. And so you had to understand the region to understand the market. So it kind of flowed together. So I did a lot of regional analysis. I've always enjoyed what's going on in the economy. Now for me, I personally really enjoy going to small towns and smaller communities. And part of it was that you might be the only economist that came there in the last year,
Sure.
and so you get a huge turnout. And I remember speaking in Columbus, Georgia, and had 2,000 people come to hear me speak, and I was like, "Wow, this is one of the largest groups I've ever spoke to." I mean, go to Charlotte, you might get 60 or 80. It's like, but in Valdosta, Georgia, another 1,000 people, and so you go out into Phoenix, you don't get as many people. You go down to Tucson, you get a much bigger crowd. It's and Tucson's not that small, but or if you go to Paradise, so you go to some other, go to a smaller market. The crowd. So I always enjoyed the small towns and trying to figure out what was going on. As we got bigger, it got tougher to do that. And we used to have we had banking that it used to be broken out into different segments. And so, and it probably wasn't the most profitable segment, but it all got rolled up into one. Right. And after that, it became tougher to get to the small markets. And but I realized how important it was going to the small markets. It was sort of like the banks in the small markets were sort of like the customers that I would go see in the larger markets, and that I'd go see their key customers. And they really would benefit from having me out there. And I was beginning to miss that a little bit when I was at Wells, although I had a great degree of freedom. I could, if I wanted to, I just call them up. I was just trying to get the expenses covered and doing it. But I covered the region. I covered housing, commercial real estate, and small business, and all of those things are more dependent upon the regional economy, and so that's kind of how it all fit together. I'm sure there were a few other things that I did too, but it's like I did work on the trading floor, and so just being there and having the experience and having it touched all aspects of the economy in my career. I mean, if I just would walk the trading floor and people would yank you and say, come speak to this. Our people would have clients that would come in, and when we moved into the newer building, we had nice meeting rooms, and so there was a lot more client interaction where you would have people come in, and so you would have these impromptu where you'd come in and just give a 10-minute talk and take some questions and move off. So we did all sorts. So all of that, it was. It was an interesting time to be there. I probably spent too much time at work. It's like, because I would generally get in at 6 and leave at 6. Although I might go to the Y and work out at some point during the day during that. But
stay there most of the day.
But you're there. I mean, if you get in at 6. I mean, I'd get in. There were lots of days where people would say, "Hey, I saw you on CNBC this morning," and I would look and say, "That was this morning? God, it seems like it was like days ago."
That's fun. So what prompted to pivot to more modern times? What prompted you to leave Wells? Why was that the right time? And then if you want to go deeper on Piedmont.
Yeah, sure. I don't know if there's ever a right time. And just philosophically, what I was thinking was, I think that I'd want to leave when I don't want to leave. Mm-hmm. I mean, I know it sounds crazy, but I said I said, I'm perfectly happy here. I'm certain I could have ridden out the rest of my career. I was 59 years old. And I said, if I don't retire before I'm 60, I'm not retiring early.
Right.
And I said, if I don't retire, before I'm 60, I'm going to have a hard time starting this other company, because people are going to say, how long, clients are going to say, well, how long are you going to commit for?
Right.
And so I said, this is something that I've always planned to do. And, back in my mind, it was something that I would have liked to have done at 50. Mm-hmm. And if I'd done it at 50, I think I probably would have pushed forward with some sort of a fund, and I still might do it, because I plan on being around for a long time. So I certainly want to move forward with it. But it's but that was the thinking in it, and it was I know that when I called my supervisor and said, we sit down and meet, and I said, well, you're never going to guess what this meeting's about. And he's like, what? And I said, and he thought maybe I was going to leave to go to another company. Uh-huh. And about 3 or 4 people all said, you're not going to Truist, are you? I'm like, what? I'm like, yeah. I was like, I said, they're a fine company. I mean, I cited everything, but I said, no. But I said, given that I've been here 30 years, do you think I would, do that? I got 5 years or so, about 65. Do you think I would make a move like that? And I was like, no, it's not. I said, no, I just really wanted to start my own firm. And I said, I said, one or two things are going to happen. I know it's a scary thing to do. It's less scary when you've put some money away and save some money. But I said, either it's going to succeed or it's going to fail. And I said, either way, I'm going to know. And I said, if not, I'm going to, ride it out here and retire and always wonder if I could have done this thing on my own. And it's exciting to me, because it kind of brings back those early days at First Union, where we were building an economics group from scratch. Mm-hmm. And I'll tell you, we didn't have a publication. We didn't have an economic indicator sheet. We didn't have a monthly outlook. We didn't have any publications at all. And so I had to develop all those. And so during my garden leave, I kind of tinkered around with ideas on the website and everything. And so was able to start up, fairly quickly right after that. And also got calls, during that time period where people were wanting to know what I was doing, if I could still speak to their group, could I get paid? And I was like, well, you can't pay me till after the garden leave, so you can't do that stuff till after garden leave. But I said, it's been fun, and I'm really having a great time. And with Piedmont Crescent Capital, I don't know when we'll start a fund, and starting a fund is kind of it's sort of like when it came to the decision to leave Wells, it's never a great time to start a fund.
Right.
I mean, you look at what's happening in private equity and private credit, and saying, "Oh, you're going to start a fund now." Yeah. In my experience, that's the best time to do something. It's the absolute best time to do it. It's going to be challenging no matter what, so you might as well do it when it's challenging. I mean, so it's like it is that. So I'm not worried about the timing. I think my concern is just the upfront cost and the regulatory expenses that you go through. That's my biggest concern, and what's keeping me from moving forward with that. I've also started, I have a second business called Southeast Economies. I saw that. Yeah. And in that, what I intend to do is to focus on the South, where I have economic reports that will cover the major markets in the South. There'll be some real estate reports that go in there, and it'll also allow me to talk about small cities, small towns. So it's like it
scratches the itch.
Yeah, and it's a region that I know very well, and I tell people I sort of feel like Jim Cramer when people ask Jim Cramer about stocks. You ask me about a small market in Tennessee or Alabama or Florida, and I can tell you about that market. I'll tell you more about that market than you ever wanted to know. I mean, so I said my biggest obstacle there is to keep it short so that people will actually read it. But But one of the ones that I wrote on there, and it was supposed to be a soft opening, but I pressed publish instead of save, and I said, okay, well, the website's up there now. And I did where I wrote about the Lansford Canal, which was a canal system that was just south of Charlotte, which enabled boats to travel up to Charlotte from Charleston so they could ship cotton down to the port of Charleston.
Wow.
And it was a short-lived venture but it still stands today. So I had some pictures of that, and I wrote about the history of that, and then talked about Chester County today, which is now growing again because it's one of the areas where you can get affordable housing. It's also where Gallo Wines put a $500 million investment to have a bottling operation on the East Coast, and so I try to mix a little history with what's going on in the economy today, and who knows, maybe that I enjoy it, but who knows, it may be a revenue making opportunity for people that are looking to expand into those small towns.
Absolutely. So for Southeast, is the goal or the vision to provide like economic reporting by request? If someone had a small town, hey, here's what we're looking to. Well,
both in Piedmont Crescent Capital and in Southeast Economy, there's the information that's on the website,
which is tons.
And then there's research that's done on an individual basis that's not necessarily on the public website. Well, I don't have the same compliance rules that you would if I was an investment bank. Mm-hmm. I do adhere to those same things. So the same forecast that's on the website will be the same forecast that I will give you. I mean, I'm not going to have more than one forecast. It's not, but there may be more details in the forecast. I mean, if you want to, you can bring it down to certain line items, and so if you're a retailer that's wanting to know about the outlook for sales in a certain market, that's the kind of sales forecast that wouldn't be on the website. That would be just done for them individually.
That makes sense. In lightly wrapping up here, I typically don't ask what do you think style questions. It's more biographical. But with you being an economist, I'm curious. So what do you make of the broader economy, I guess we can talk about, but maybe more the real estate market and the real estate market in the Southeast. We have a lot of interesting trends where we still have a lot of net new demand, but we have high rates. In some markets, they're well overbuilt. So then you have all these new construction credits, and resale homes are lagging a lot too. So it's just a very peculiar real estate time. And then in other markets across the country, they're saying, oh, we're starved for lots, or we need supply. So how do you kind of unpack this?
Well, I think that the economy overall right now is very confounding to a lot of people. And I think what's made it that way is there's a lot of structural impediments to growth right now. So it's not purely a cyclical exercise.
Okay.
And that's true for the overall economy. It is particularly true in housing. And one of the things that I tell people about housing is the Joint Center for Housing Studies at Harvard, which I'm on there's a group called the Harvard Industrial Economist. It's a little board that gets together a few times a year. But I closely follow their publications. They recently came out and said we're going to need 18 million new homes and apartments over the next 10 years. And when I read it, I said, that's great news from one perspective, but it's not going to happen. It means that the shortage of housing is going to worsen because I don't think we have the capacity to build more than 1.5 million homes a year in the United States because we don't have the workers, we don't have the lots, we don't have the infrastructure in terms of building materials. And so, affordability challenges would come back if we tried to force it. And we have some serious impediments. When I say it's structural, this is the serious impediment, and that is, it used to be that you drove to qualify. In order to get more affordable housing, you move further out. So in Charlotte, you go to Chester County. Mm-hmm. In Charleston, maybe you go to Walterboro. I don't know. You would have to you'd go further inland and off the beaten path. But the cost of providing infrastructure now is solely borne on residential development because you don't get as much commercial development as you used to. With online shopping taking 25% of the market, it means you don't get as many Walmarts, you don't get as many Home Depots. And there's not as much office development that's taking place in suburban markets. There's not a whole lot of that. So that means that residential development has to pay all the freight, which means that the starting point on building a home is like 170 before you pay for the lot, before you buy any materials or hire anybody to nail anything together. So it makes it really hard to build anything anywhere, even in an area where land is really cheap for less than $300,000. And if you're in a large metro area, it means that it's hard to build anything under $400,000. And so there's a tendency to do more townhome development where you can get a little bit more density. But single family development is just really tough to pull off, and that's true of everywhere. And I've been, and even in the small towns that I go to, like going, we can't develop. And I've been to places all over the country that just surprised me. That I remember going to Sioux Falls, and you would think, oh, they're never going to run out of land in Sioux Falls. And Sioux Falls is seeing a huge influx of residents from Minneapolis. Wow. So you're having and it's a rapidly growing city, low taxes, beautiful place. But they've got pressures because of infrastructure, where you can put infrastructure around Sioux Falls. There's only certain, and they don't want to just keep going into the farmland and pushing further out and putting one house on 6 acres or something. But so in a state that's just got a ton of land and not a whole lot of people, they still have a tough time getting affordable housing right. So that's a challenge that's going to be with us for some time. I don't know what the answer is. I think that it probably has to come from Washington, and I think it has to be something on the order of maybe we have a new class of municipal bond that enables municipalities to further reduce the cost of infrastructure for residential development. Because residential development, we're talking about the quality of life for our citizens as a country. It's something we probably need to look at. Nobody that I know of is looking at doing anything like that, but we have to address that's a structural impediment to it. In terms of commercial real estate, we're actually a little bit ahead of where I thought we'd be. And at least in an overall perspective, it looks like office vacancy rates actually fell slightly in the third quarter. The Charlotte market had the fourth largest net absorption of office space in the country over the last year. And I was speaking to a group, and I said, given how strong things have been in Charlotte, I wouldn't be surprised. There's 2 buildings that have been talked about. I wouldn't be surprised if one would move forward. And sure enough, a week later, and actually, there was someone who thought I was so full of it that he stood up and said, there's no way that's going to happen. 1 week later, Riverside announced they were going to build Queensbridge Collective, the office tower. Yeah. And one of the things that I think is very rare, they said that construction would begin immediately. You rarely ever see that with an office project. And so work is underway there. They're doing a similar project in Nashville. And so a market that we thought was going to be dead through the end of the decade, I never thought it'd be dead through the end of the decade, but that's kind of the general thinking that was out there, that office is dead forever. We heard the same thing about retail. Oh, we're never going to build any more retail space. In fact, that we didn't build any more retail space. Retail vacancies are very, very low. Industrial market is probably a little more challenged right now because the good side of the economy is soft. The apartment market's got just a flood of new apartments, which is, it's going to, but demand has been real strong because people have been renewing their leases because they can't afford to buy a house. Right. And that's the part of home buying that's really lacking, are those first time entry level buyers who just aren't there. But still, I think apartments are going to have some indigestion the next couple of years, and we'll probably see apartment slow a little bit. But overall, I'm thinking commercial real estate looks pretty good, particularly in markets that are growing rapidly. Right. And within the South, kind of the hot spots that I see, Charlotte and Nashville really are way out front. Raleigh has slowed a little bit, mainly because some of the federal government cutbacks have hit the universities, and they've hit some of the research organizations that are there. Longer term, they're going to be fine. They've got just one of the everybody in the country is envious of the base of industries that they have there and companies that they have there, and the pharmaceutical industry is growing very, very rapidly. The IT industry is not. Apple had committed to build a big park there, and they really haven't done much on there. So it's but where we're seeing that growth is really accelerating is in markets that are still affordable. So Alabama is in the top 10 in something other than football now. They're right. So Huntsville is one of the fastest growing markets in the country, as is Gulf Shores, which is on the coast. Yeah. But Birmingham's looking a little bit better. Fayetteville, Arkansas, another place that people would say, where on earth is that? And I'm like, well, suddenly that's way on the charts, and it's an affordable market. They've had a huge influx of business, and in Texas, San Antonio is now the fastest growing market because it's a lot more affordable than Austin. The two metro areas really kind of adjoin one another, but there's a market in there that I used to go and visit all the time, San Marcos, which is right in the middle. It's where Texas State University is. And it has always been a very rapidly growing place. It's about equidistant between Austin and San Antonio. Wow. And so growth is moving around a little bit, but I think a lot of the areas that were booming in the last cycle in the South are going to be booming again. It's just that right now, affordability is a big driver of growth. It's a big driver of where people and businesses are moving right now.
Yeah, I agree. Last couple questions, Mark, for you. So I ask these same three questions each time, and we may have touched on them a little bit, but what are you focused on now, more specifically speaking, for the company, so for Piedmont? Like, if you were to summarize, like, what are you focused on now? Are you looking to get more clients that you're expanding with? Are you looking to expand more with Southeast? The fund idea seems to be on the radar. Is there a kind of sole focus of the next couple months or quarters?
Well, I think that for a while I was so busy building out the infrastructure that I didn't have time for more clients. I do have time for more clients now, so I am looking for one or two really good clients. Got a couple that are looking promising right now, and it needs to fit with what I do. I mean, I don't want to. I mean, I want to leverage a lot of the work that I'm already doing, and so, I don't know if it'll be next year or the year after that. I don't know if it's a 26 or 27 issue that where I'll start a fund, but coming from one of the nation's largest banks, it's kind of hard for me to think of not having a really large fund. And if I've talked to people, they're like, "Oh, you got to start small, Mark. You got to start small. You start big, you're going to make some. You're going to, you go back to that lesson that I learned at Winthrop. Too much liquidity will make you do stupid things. So it's like, start small. So I realize that, but there's just so much cost. So maybe I'll look for a partner in that. I think I'll probably do that in order so I don't have to get hit with all that upfront cost. But those are a couple of things that I'm looking at, and I want to develop the Southeast economy idea a little bit more. And if I ever had time, I would like to write a book or two. But I've got a lot of friends that have written books. And they're like, Mark, he said, I've talked to one guy. He said, I've never given childbirth, because it's a guy. Never had given birth, but it's got to be close. It's like it's an awful lot of work for a very little bit of money. But he said that I might be better suited for it, because he said it's better suited for someone who goes out and does a lot of public speaking. So
interesting.
Might do that.
So the next one was, is there any service, product, or market that you haven't been in that you would like to be? Now, you've kind of answered that with the fund, right? That would be a product, in the book kind of fits that component too. But is there any service, so to speak, for Piedmont that you don't offer now that you would like to?
Not really. I mean, one of the things that I didn't mention is that one of my clients is a company called Kavu Securities, and they're a minority-owned, veteran-owned firm out of New York, and so I write their economic outlook, and I also call on clients for them. I'm open to just about anything that an economist would do. I mean, so it's like so I do client calls, and so most of their clients are actually, it's a little different from the Wells clients in that they tend to be larger businesses. I mean, so they might be a Wells or Bank of America or a Coca-Cola or somebody of that size. But of course, you're not calling on the whole company; you're calling on one segment of them.
Mm-hmm. Of the company. Interesting. Last question. So who do you think helped you the most along the way in your career, maybe as it pertains to being an economist? You've worked with you've name dropped quite a few interesting and high profile folks that it sounds like we're calling on you. Who do you think helped you the most along the way in your career?
I will tell you that two of the people that helped me the most, one was my high school soccer coach, and I was a goalkeeper. And you know, I was really nervous. I had a hard time, just so nervous because, I mean, if I made a mistake, they scored. You know, it was like, and he told me, he says, you know, you practice hard. He says, you practice hard, you rest, you get ready, you're ready for the game, and you give your best effort. And if the ball gets by you, you know, you have nothing to be afraid of. Mm. He says it's only if you're not prepared and if you don't do the right thing and you don't give your best effort. And that just kind of carried through with me in the work world and in the economy. It's like, so, you know, you're not, you know, in economics, you're never technically going to be right. I mean, what are you going to do? You're going to nail each number right to the decimal point? I mean, that's just not going to happen. You are going to make mistakes, but, you know, you just need to try your best. And, you know, and the second guy was Coach Cassida at Winthrop, who you know, he didn't even realize it, but he was looking at my grades and he says, you know, you do really well in mathematics. You really do really well in some subjects and not well in others. And I said, well, you know, I'm interested in those, and you know, it's like related to. And he goes, that's not the way to look at it. He says, you don't know. He says, the purpose of getting an education is to learn what you don't know that you need to learn. He says, you know, you need to broaden yourself, and so. He kind of taught me to think more broadly about things. But you know, all the people that I worked with, John Godfrey at Barnett Banks, he was a veteran from the Federal Reserve. He taught me a lot. You know, you learn a lot when you don't even know that they're teaching you things. You just pick up things, and you know, I learned a lot from him. Dave Orr, who I worked with at First Union, had a different philosophy on economics, and that he really looked at the economic numbers as a business person would look at them instead of as an economist, because he was a history major and not an economics major, and you know, it was so much more practical the way that he looked at things. And I thought it was kind of interesting that Ed Hyman, who was the institutional investor named as the top economist on Wall Street year after year after year, also a history major, not an economist. Not an economist by training, right, not an economics, not a PhD economist, and so, you know, I tell you, I learned a lot from Ed too, reading his stuff over the years. But I, you know, it's, you know, John Sylvia, who I worked with at Wells Fargo, I learned a lot from him. Although he came from a government background, and I think what I really learned from him was the hard-headedness of government and how much. You know, when you think about businesses, you think about how much they invested. You don't really think about government and how much time and energy they've invested in certain priorities and how hard-headed they are about change. And so I've learned those things. And then I learned a lot by myself. And then one of the things that I feared the most in leaving Wells and retiring was that I wouldn't have access to the wealth of information that I got. And for a long time before we had the ability to get everything electronically, we used to get things in the mail. We used to get things faxed to us, and then they were emailed to us. And I would keep every research report. I mean, if I read a research report and I marked it up and had my notes in the margin, I'd keep it. And it used to be all in boxes upstairs. I went away for a trip. My wife bought a scanner and scanned it all in. Oh, my. And from that moment on, I said, you know what? I'm not going to print it anymore. I'm just going to read it on the screen and just email it to myself. And that got to be a problem at the bank because they're worried about sending other things out. So I'd have to print it and then scan it back in. But whatever. But I have just about every research report, whether it's Goldman Sachs or Morgan Stanley or people that don't even exist anymore on just about every economic report going back to the 1990s.
Wow.
And I remember reading it, and so it's good to have that. And and now with OneDrive, I can get it anywhere. It's like, but so when something happens in the economy, and I remember that it happened previously, I can go back and look at it and say, this is what we did back then. And there is a wealth of information. As it is I have access to virtually everything I did at Wells Fargo. I mean, I still talk with a lot of economists, and they just put me on their distribution list, and it's great to have all that access. And I also subscribe to a few things in terms of having data access to things. And it's so I don't feel like I'm out of the loop. That was my biggest fear in retiring, was not that I was going to have to be struggling to feed myself or something. It was that I was worried that I wouldn't have access to information. I mean, that was my biggest fear, and I was like, and thankfully that's not a problem. I think I have information. I think I have every economic statistic that is publicly available worldwide. I have at my fingertips, and we published a report on Moldova. And because I'm focusing a little bit more on geopolitics, something that's always interested me, and I didn't really have the option of doing that before. And in Argentina on Malay, and if you go back on Piedmont Crescent Capital and you pull up under regional reports, you'll see a report on Malay, and it was written before he was elected. We were one of the few people that actually my son has got a big interest in geopolitics, and before he went into the Navy, he had written about that, and so I took that and made it more brought the economics into it a little bit more. But there's incredible things happening around the world, and I'm trying to incorporate that into a way and to show people how that would impact their business. And I'm just having a great time doing it.
That's amazing. Mark, I think this has been extremely thorough. This has been fantastic. Is there anything we missed or that you wanted to finish with, Piedmont-wise, or in regards to your life or your career that we missed?
So about the only thing I'd say is that, I encourage people all the time. I said, I'm not going to try to sell you anything, but if you go to Piedmont Crescent Capital or southeasteconomy.com or follow me on LinkedIn, I think you'll enjoy the economic reports that we put out there. And we don't have any passwords or anything, so it's all publicly available. And I encourage people to get out there and check it out, and do me a favor if you really like it, spread it around and share it around. I mean, I'd like to get it out there as much as possible, because my business is all in kind of in the soft sell, and that maybe somebody will see it and say, hey, I want to get this guy to come speak to our board or come speak to our organization, or maybe to do some more specific research for them. But in order to do that, I just need to get the word out.
Absolutely. Mark, this was great. Thank you so much.